Hello everyone, it's Logan and I hope you are well. I'm making this video to answer some questions which have been brought to my attention regarding a video I made a couple of weeks ago. As you should know from the title, this past video was made regarding the risks that widespread indexation and passive investing have added to the markets, and why Michael Burry, the famous investor who shorted subprime mortgage-backed securities, doesn't see passive investing ending well. Now, since then, some common questions and rebuttals to what I talked about have come up, so today I will attempt to set aside my preconceived view that index funds are distorting the market and probably in a bubble, and I will hopefully be able to step you back to see where not only myself but other notable investors see potential problems coming in the area of passive investing. So to get started, let's set aside ETFs and passive investing. Let's look retrospectively at some past bubbles which have burst, and how people lost their perspective during these bubbles. For simplicity's sake, let's go back recently, just back to the early 2000s. When the housing market was booming, more Americans were owning homes than ever before, and this was celebrated as an encouraging sign of economic growth. Also, mortgage-backed securities were seen as the no-brainer investment for the majority of investors. These securities, the most common and popular of which became the collateralized debt obligation or CDO, were seen as very safe because vast numbers of consumers had never before defaulted on their mortgages at the same time. So it was seen as a way of diversifying into an already stable and safe market. Because of this, many pension funds, hedge funds, institutional investors, and retirement accounts bought heavily into these subprime mortgage-backed securities, and this eventually distorted the market immensely, leading to the great crash of 2008. So we now know how this ended, of course. Eventually, due to the investors' unending appetite for these mortgage-backed securities, the quality of the underlying securities gradually degraded until the ratings became immensely skewed. Rating agencies such as Moody's and Standard & Poor's were incentivized by competition as well as profits for themselves, and they almost always gave ratings on these subprime mortgage-backed securities which were not representative of the risk. So they might rate them as AAA, the best investment quality and lowest risk, when in fact they were far higher risk and complete junk. And if you want a good summary of this bubble and want to gain a better understanding of it, there are many great resources out there, but just to understand it and the complexity of it, reading Michael Lewis's book, The Big Short, which features Michael Burry and several other investors who saw this bubble coming, is a great way to understand just how immense of a bubble this eventually became. So the question we might wonder now is, why were people so deceived to buy into this back then? Why couldn't more people see this coming like Michael Burry did? Why was it so hard just to read the underlying financial statements behind these CDOs, which apparently very few people did, and Burry was one of the only few people who actually read them. And, the answer to this likely lies in the nature of crowd-thinking mentality and the herd-driven mentality. And as you should know from the name of my channel, I always try to think for myself when I make investment decisions. I ignore the sentiment behind an asset or a stock or whatever it is, and I look at the fundamentals, and I let that speak to myself before anything else. And quite often, what I see is either mindless optimism or mindless pessimism in the market or a stock or whatever, especially in this age of almost instant connection and the ability for people to think in groups and to form groups of like-minded people. So, for example, look at the Bitcoin and crypto mania just a few weeks ago when these tokens were breaking to new all-time highs and going parabolic, and they were in the media all over the place. People began jumping on the bandwagon, mindlessly putting the maximum amount they could toward these tokens. I remember asking people I know who were buying then, why are you purchasing Dogecoin or Ethereum or whatever? And they usually couldn't give any real strong fundamental reasons. It always had to do with some, mindless reason. All my other friends have told me Dogecoin is going to $10, or Elon Musk just tweeted about Bitcoin and Tesla accepting Bitcoin, or he tweeted about Dogecoin or whatever. And most of these friends of mine didn't even know what these tokens actually were. They didn't know if they were actually worth anything. They didn't do any analysis. They didn't know that Dogecoin was created as a joke in a matter of hours by a programmer. They didn't know that Bitcoin is 65% centralized in China and that it has experienced 3 crashes of 80% or more since Bitcoin was created just 10 years ago. And what happened to this? These tokens crashed 50% in a matter of 2 weeks, and they're at least in a bear market, if not a complete crash. It's kind of unclear right now. So how does this apply to ETFs and index funds, you might ask? Well, similar to both of these examples of the subprime mortgage-backed securities bubble, as well as the recent frenzied-driven buying in crypto tokens, I believe Michael Burry is correct to point out the risks inherent with buying into any herd-driven asset. And even though there isn't much hype on social media, or Reddit for the S&P 500 or the Nasdaq, I believe that the massive inflows passive investing has received since the great financial crisis has led to another massive distortion of the market. This time in virtually all of the stocks which are included in these ETFs. And I've seen so many comments out there, on this past video of, well, index funds might crash, they might correct, but they will outperform the market over time. And, I can't state how incorrect this thinking is. First of all, the degree to which passive investing now controls well over 50% of the total market has never been present in modern history, or history at all, I don't think. In other words, looking back just 10 years ago, the control passive investing had was significantly less. Also, passive investing is a new invention, as the oldest index fund was created in 1976. That's the oldest ETF or index fund, with most of the ETFs out there being much more recent, last 20 or 10 years. So in other words, you can't say passive investing has performed better than active investing over a long period of time, as passive investing, is only a concept was invented 45 years ago, and it has only been mainstream for at most 20 years, and it has only been the majority of the market for roughly the last 5 years. Now, passive investing, as I have stated before, has made it not only possible, but very probable for massive volatility spikes to occur, which did not happen in a less passive-driven market. The reason for this is the passive algorithm is not dependent on company fundamentals or logical thinking. It's a very simple algorithm. It's if money flows into this ETF by a proportionate amount of the underlying assets. And also, if money is being withdrawn, sell a proportionate amount of the underlying assets. That's the entire algorithm right there. And the reason why this is such a big issue now is, what happens if people collectively need to sell at approximately the same time? Well, all of a sudden there is a much higher selling volume on these underlying assets than they typically experience. And the prices of these underlying assets drop significantly as a result until enough buyers step in, as the ETF price as a result goes through an immensely volatile drop. And typically this is only seen on the downside, as selling almost always occurs more rapidly and in higher collective volume than buying. For example, look at the Russell 2000 during the COVID crash in 2020. This crash was a crash of 40% in only 6 weeks. Why was it significantly higher than the Nasdaq's crash during this time? Even though the fundamentals are more sound on these small caps. And the answer has nothing to do with the fundamentals or price discovery or anything. Rather, these small, usually unknown stocks had significantly smaller daily buying and selling volume than these large cap tech companies that everyone knows about. And as a result of significantly higher selling volume, they dropped, significantly more than these larger companies, which, when added together, resulted in the Russell 2000 dropping much more rapidly. So all of this being said, I'm not trying to paint some dire market crash picture or give any sort of advice in any way. I'm only examining the commonality between, the idea that passive investing funds, you are somehow avoiding risk, and past bubbles such as the subprime mortgage-backed securities bubble. As history has shown, when the majority of people are buying anything, it's time to step back and question the assumptions behind the underlying asset. And you'll never hear somebody like Jim Cramer or any of the Wall Street media talk about this either, because all they do is play on the emotions of the crowd, and if anything, they encourage, the crowd in what it is already doing. But I just wanted to warn you, those of you willing to listen, that just like all prior herd-driven assets have not ended well, I do not think this is an exception. All that being said, I hope you enjoyed this video. If you did, consider subscribing and hitting the like button. If you didn't enjoy the video, give it a thumbs down and let me know why down in the comments, and I hope to see you again.